And today we wanted to talk about policy design that addresses pretty well one of those common misconceptions about how we structure these policies.
Banking is the most profitable business in the world. And if we can take over that process through a system of policies, we will be the benefactor of that process or of the riches that banks see. Most people, when they do look that up, they just find what the cheapest thing is. And they don't even know what all those living benefits are.
Every client says, I wish I had started this earlier. And every client says, I wish I had gone bigger on my first policy. We're saying that if you're going to invest, there's a way to do it from a position of safety and strength.
Nobody ever actually takes the time to complain all the contractual rights they have when they do a whole life insurance policy. So they simply just see a number and they see a cost. They don't see the value and they don't see the price they're going to pay by trying to have the lowest cost. Every dollar you put into the contract or that you pay in premium will be available in cash value that you have access to because that is liquid and it's guaranteed.
And term is cheaper than whole life, but if I want whole life, here's the type of policy I can get. And people look at the growth, they look at the cash value accumulation, and they think, well, this is not for me because it's going to take me a long time to even get anything out of it.
We know all of this money is coming back into our lives in a very short order, and it's going to it's going to be profitable to us through our lifetimes.
You have to break yourself of the mindset that we're used to with insurance, which is I want as much coverage as I can get for as little premium as possible. And jumping forward to how your policy is structured, it's going to be a combination of
What's going on, Hans? Back for another episode of the Remnant Finance Podcast. How you doing?
Good, man. Yeah, looking forward to it. I'm really enjoying getting to put our conversations with clients that recur over and over. It's nice to put it on a recorded medium so that we can get that information out there. Really, so far, we're 2 weeks into production and release. So far, I've had really good feedback, and hopefully, if you have any comments or suggestions, we're happy to discuss, and we're learning as we go. But so far, really enjoying the podcast. Hope everyone listening is as well.
Yeah, same. Yeah, everybody, please leave your comments, or if you know us, send it to us, or leave it in the comment section of wherever you happen to listen, whether that's Spotify or Apple or YouTube or any of the other platforms that you're listening on. We'd love to get your feedback, and some of that can turn into future episodes. So we'll answer you there, and we could probably dive a lot deeper. But it's a lot of fun because not only do we have these conversations with our clients, but sometimes we have them with each other pretty often. So it's pretty cool. We can almost just record what we talk about anyway.
Yeah, and this will be a timely episode just based on the feedback we've gotten so far. The episode that was released most recently was about the common misunderstandings and the myths around whole life insurance. And it's funny, we talked about where do these ideas come from, and we hit on the idea on the phrase that most people's understanding of life insurance comes from someone else's misunderstanding. And it was really funny, we talk about the myth of this not being an investment, that the comparison to an investment is the natural kind of knee-jerk reaction, but that's not actually the right comparison, and that's not what we were trying to convey. And immediately the comments were disparaging of whole life were about how it's not a good investment, and it was just confirmation of the fact that like people have such a hard time in their minds separating what they've been told about life insurance and what they've been told is the ideal strategy, which is just grow your money, and rate of return is the only metric. So we're seeing that kind of play out in the feedback, and that's why we want to continue to put out this information. But you had a video that you released, so talk a little bit about that this week.
Yeah, I just a couple of days ago, I thought it'd be fun to record a response to a Dave Ramsey call. I think it's about 3 years old. So a gentleman calls in, and some advisor or an agent or somebody that he was speaking with recommended, and it sounds like accurately and well described, infinite banking to him as something that he might want to do. He was in, baby step 7 of Dave Ramsey's plan. So he probably had a nice amount of free cash flow.
Which baby step 7 is just to grow wealth. It's just you do all these things that are fairly specific, and then 7 is just get wealthy. It's like, well,
just get wealthy, putting money into those mutual funds. But so what I ended up doing was, at that point, it's probably a 10-ish minute video. I can't remember the original call where Dave just goes on a tirade and just tears apart whole life insurance, their agents, infinite banking, everything about it. And he does it quite inaccurately with a lot of misconceptions. And, he has a monster audience, a massive, massive audience. So the unfortunate thing is that's exactly what you were talking about, and what we talked about in that previously released episode was most people's understanding of whole life insurance is based on somebody else's misunderstanding. And when you have an audience in the millions, like Dave does, that's a lot of people that are going to get the wrong advice or going to be led down an incorrect road about what whole life insurance is and how powerful it can be. So I recorded a little response video. It's about 30 minutes long where I just play the video, pause it every time there's something that I think was worth mentioning or worth talking about. It probably could have been an hour long, but I had to cut it somewhere. So go to Remnant Finance on YouTube and you'll find that video.
Yeah, this is a great video. And the feedback again on that, it's interesting. There is a mental block that is very real, where we can literally say, like I said, this is not an investment vehicle. We're not talking about investing. We're talking about, where does the money that you invest come from? Where does the money that you buy real estate with come from? Where does the money that you purchase a car with come from? That reservoir should be optimized, and that's what we're trying to do. And we specifically said, hey, we're not saying not to invest. We're saying that if you're going to invest, there's a way to do it from a position of safety and strength. But the immediate response was just, look at the ROI. This doesn't make sense. And it just whew, right over, which is fine. That's why we're trying to put this content and contribute to the base of knowledge about this. But it leads in well to what we wanted to talk about today, because I understand why people don't understand what we're talking about, because most people's experience with life insurance comes solely from, you go online and you just do a quote generator, and what's the cheapest insurance I can get, and term is cheaper than whole life, but if I want whole life, here's the type of policy I can get. And people look at the growth, they look at the cash value accumulation, and they think, well, this is not for me because it's going to take me a long time to even get anything out of it. So even these benefits you're talking about, yeah, sure, it's great to have these rights in the contract to do all these things, but if I can't use it for 10, 20 years, what's the value? And so we want to talk about, we were planning to do a couple episodes, and so far we've been focused on kind of philosophy. We've been more, we've been like a little bit bigger picture, but we want to talk about a few specifics in a couple episodes. And today we wanted to talk about policy design. And so that gets into that addresses pretty well one of those common misconceptions about how we structure these policies.
Yeah, but before we even start that, based on what you just said, I want to respond with, most people, when they do look that up, they just find what the cheapest thing is, and they don't even know what all those living benefits are. So I actually think you're mistaken on that, in that they haven't discovered any of that. Nobody ever actually takes the time to complain all the contractual rights they have when they do a whole life insurance policy. So they simply just see a number and they see a cost. They don't see the value, and they don't see the price they're going to pay by trying to have the lowest cost. So it's that whole conversation that we dabbled on, and I think we could do a whole episode on here coming up, of cost, price, and value.
Right.
And you have to really think about all three things. And it's just it's something that is there's a ruts in our brain that are stuck there from years and years and years of conditioning. And the other thing I wanted to address was, before we start, is, the same thing you talked about. I think one of the comments said something like it's a scam on the Dave Ramsey video because the rates are lower. And that's a failure to address why we do infinite banking, which I think I'm gonna try to say this every episode. It's to solve the problem of the fact that we finance everything we buy. We either pay interest to an outside entity, or we give up the interest we could have earned when we pay cash. And so when we solve for that and take over the banking function for all of our large purchases, investments, and things like that, that will enrich us almost potentially more than anything else in any other rate of return. Banking is the most profitable business in the world. And if we can take over that process through a system of policies, we will be the benefactor of that process, or of the riches that banks see. So it's not always about rate of return, and infinite banking certainly isn't about internal rate of return. Anyway, policy design. Let's get under the hood on that. And this kind of is our first in the mechanics. So we're going to start touching some mechanics of the policies and of infinite banking. And there are two basic types of premium. Hans, I'll let you run with that.
So we've got base premium and we've got paid up edition premium. And jumping forward to how your policy is structured, it's going to be a combination of those two types of premium. When we talk about a ratio, a percentage split, we're talking about how much of the total premium is going to be going towards the base part of your policy and how much is going to go towards the PUA or paid up addition rider. A rider being an attachment that you pay for on the policy, which allows an additional contractual right on top of the base contract. If you have an experience with whole life insurance, very likely it is only a base policy, and that's what most people are referring to when they have the criticism of, well, it's going to take me 15 years to have anything to show for this, so why would I do it? Well, very likely you're thinking of a base only whole life policy. The base is purchasing a large chunk of death benefit, which requires payments over a schedule till 65, till 95, or for 10 years, for 20 years. That's the payment period for your base. And because there is a continual flow of scheduled premiums, the death benefit for that is going to be a lot higher dollar for dollar than the other type, which is paid up addition. So comparing it to the base, what would be the paid up addition?
So the paid up addition, yeah, the base, like you said, is just the vanilla. It is what you pay just to have a whole life insurance. The paid up addition now is somewhat similar in that when you purchase what it's considered paid up additional insurance, but it's like taking out a small policy that you only have to make one payment on. So what I mean by that is, let's say you're going to use $100 to buy what's called these paid up additions, and this is a rider. When it comes to whole life insurance, a rider is just an attachment, a contractual attachment to the policy that you have the right to do or the right to take advantage of, or that you're paying for. So we have this rider called PUAs, and we pay like $100. That, based on your age, your health, your ratings, and all of those things, that's going to buy you a certain amount of insurance. So let's say you're 25 years old, it's probably going to be 4 or 5 times, I'm guessing, but just for illustration's sake, 4 or 5 times the amount of money you put in will be available in death benefit. And then you're done. So it's kind of like a standalone policy. So I pay $100 to the insurance company. They're going to give me $400 or $500 if I'm that age. That will change over time. They're going to give me $400 or $500 in death benefit, and I never have to pay it again. But because, and typically that would be a bad thing if you could do that with all insurance, it causes tax implications. But because it's a rider that's attached to this other base premium that's attached to your policy, what it does is it's completely paid up like the name implies. So it gives us a lot of cash value. Approximately 94, 95% of that $100 is available in cash right away because it's already reached a high level of equity towards the death benefit. All of that money is available. We're not paying the administrative costs. We're not paying, all the fees and things that come with starting a policy. It's just boom, one and done. Doesn't require extra underwriting or any of those sorts of things if we've already done the underwriting process. I kind of think I'm going on a long tangent here.
Well, the analogy, and I think we've made this before, and it's a way that people can better wrap their mind around what we're talking about. Most people understand in a mortgage that it takes a while to build equity in your home. You could pay into your mortgage for 5 years. On a 30-year schedule, you do not have 1/6 of the equity in that home. It's not linear because of the way that interest is calculated on a mortgage. Most people understand that the majority of their monthly mortgage payment is going to interest in the early years, and that scales down over time. But they also understand that if they were to make a principal only additional mortgage payment that month, or additional payment to their mortgage in that same month, that principal only goes right to equity. This is not a perfect analogy, but it's close enough that you can kind of wrap your mind around how, when we say we get early cash value growth and accessibility relative to your standard base only whole life policy, you can almost imagine like we're figuring out how much of our annual or monthly total allotment is going to go towards the base premium is kind of like how much is our mortgage payment, and then how much are we going to put towards principal only. And we understand that $2,000 towards our mortgage in a principal only payment unlocks us $2,000 of equity. And if you're kind of making the rough analogy here between equity in your home and cash value, hopefully that sort of kind of spurs you along the path to understand how we can generate cash value early. If a significant portion of our total premium is going towards paid up additions, and paid up additions translate to cash value, like you said, around 95% or so of that amount paid immediately, then you'll have a better idea of why the criticism of it takes forever to get anything out of it is not true the way that we structure these policies.
Yeah. Although one thing I will add is that I like to think of it instead of it's because it will increase the equity or the value of the home. So when the only place that breaks down is when you pay the extra paid up additional insurance, it's going to increase the death benefit too. Whereas in your house, when you just make the extra payment, you've got more equity in the home and it's all equity. It's 100% equity, but the value of the house didn't go up without some external thing happening. So that's the only place that I think isn't a perfect parallel. But I think a nice way to say is like, if you let's say or you have a $500,000 home that's mortgaged and you have $100,000 in cash and you pay 100% to put an addition on the house, that will increase the house's value and you will have all the equity in that portion if you didn't take out a loan to do it. You just paid the contractor to add on a room or, some part of the house. So the paid up addition is like an add-on to the main structure of the home.
Yeah. Yeah, exactly. And one thing to know, because it's a rider, you got to pay your base policy to keep the policy in force. That's part of it's a unilateral one-way contract. Once it's in force, as long as you pay your premium, the company can't change the contract. You have to pay your base premium to keep your policy in force. You have the right, but not the obligation, to pay that paid up addition. So when we look at it and we look at this growth, we want to pay that paid up addition because that is how we get over that initial slower cash value growth that the base policy generates. Now down the road, that base policy is going to be much more efficient in spitting out cash value than is the PUA, because the paid up additions, whether it's in year 1 or year 30, is going to translate roughly 1-to-1. Like we said, all right, like 5-ish percent, 4, 5, 6% of it is going to go towards the cost of insurance. But if we loosely call it 1-for-1, whether it's year 1 or year 30, that dollar into paid up additions is going to yield almost $1 in cash value that is generated. But the base, while it's not generating dollar for dollar early on, it's going to be more than dollar for dollar. It might be $2 or $3 down the road. And so we use this paid up addition premium, especially early on. That's where it's most powerful in order to do what we're trying to do, which is build up cash value earlier so that we can actually use it in cash flow, et cetera. Do all the things external to the policy that we want, and having that savings component of it, where we think of that PUA premium dollars as almost just going into the savings account of the policy. Again, not a perfect analogy, but that's kind of how you can think of it.
Yeah. So to kind of just sum up what a paid up addition is, because it's a little bit hard to describe that it's like an individual small paid up insurance policy, but it's just that. It's additional life insurance that you're purchasing using, extra outside money attached to the policy. So you're buying more life insurance, more death benefit, and it's just like it sounds. It's completely paid up. So you're getting all the cash value available, or a lot of the cash value of that death benefit available right now. So unlike your base policy, you don't have to keep paying premiums once they're purchased. They're like small little packets or small little add-ons of life insurance that's kind of included in your total death benefit. And they also earn dividends. They also earn interest. And then those dividends also are used to purchase additional paid up insurance. So there's 2 ways to get that paid up insurance: through dividends and through outside funds. When we structure these policies, we build them so that we have our base coverage and then the ability to pay outside funds to do these paid up additions. And that's what gives us that cash engine early on.
And so let's talk about premium as an expense versus premium as savings, or premium as purchasing an asset. Now, there's a reason that on a balance sheet of a bank or a corporation, who, by the way, buy truckloads of whole life insurance, it's on their balance sheet as an asset. It's not an expense in their budget. So that tells you something. When we look at our premium, we're talking about putting money into an asset that has all of these powerful benefits for us, but you have to break yourself of the mindset that we're used to with insurance, which is I want as much coverage as I can get for as little premium as possible. My renter's insurance, my car insurance, homeowners insurance. I want quality coverage, and I want to squeeze down that premium because it is a one-way expense. And that's the same as term insurance. You're renting insurance. And so there's a place for those types of insurance. We use them, we need them, we have all of them. But when we're talking about our whole life premium, we're not talking about a one-way budget item expense that goes out the door and we hope we don't ever need it, like you do with term, like you do with car insurance. We're talking about moving money from one less efficient vehicle, like your standard savings account, to a optimal vehicle where you retain access to it. So when I pay my premium, it's not just out the door. I can log right in. And because a large chunk of it is in the form of those paid up additions and I'm getting dividends, et cetera, I see that money still right there on my screen and accessible. And so you have to think differently about how you view your total premium. And people start from the premise of, well, here's my budget, here's what I make, here's what I spend, here's what's left over. There's no way I could put in enough money. I don't have enough money left over at the end of the month to fund this big whole life policy. But that's because you're thinking of it as an expense. If you understand the order of operations and the value of putting money, flowing it first into this efficient savings vehicle that also protects your family, that also gives you the ability to access and invest from, it's not just an expense. It is so much more than that. And that is the paradigm shift in how we think of insurance that you need to get over in order to do this effectively. And if you can't get over that, you're never going to implement IBC because you're going to view it as an expense.
Yeah, and one of the reasons it's saving is based on the policy designs and just based on the mechanics of how whole life insurance works. We're just going to speed up the ability for it to turn into like a, I put that in quotes, turn into a savings account. So when we build these policies, we're going to have a base premium like we described, and we're going to have a paid up addition that's going to, let's just call it some ratio. It's all going to be different, and it's all going to depend on goals. But usually it's somewhere in the neighborhood of, I don't know, 4 or 5, who knows how many years, you hit a point in all whole life insurance contracts, but we're going to speed it up with paid up additions where every dollar you put into the contract or that you pay in premium will be available in cash value that you have access to, because that is liquid and it's guaranteed and has all these benefits that we've described in previous episodes. So if I take that premium out of my left pocket and just move it to the right pocket, do I still have access to it? Did I lose any money? Was it an expense that went out the door forever? It's just in the other pocket. So think of, your left pocket as your checking account, your right pocket as your life insurance policy. I can still take it out and use it. And I just have all kinds of new contractual plan or contractual guarantees with it. Now, the best thing about life insurance, and the reason that we want to pay substantial premium as it relates to our income, is that will always get better over time. So I mentioned 4, 5, 6, I don't know, it depends on the policy design, years away, where you can be dollar for dollar. Every dollar you put in is available for you in cash value. And what that means is that all of the cost of the insurance, this amazing death benefit, is already behind you. So now it's just a savings account. But every year that's going to get better. So 10 years down the road, it might be 1.5. I don't know. 20 years down the road, it might double. So you put $10,000 into premium and you have 20,000 available. I don't know exactly what that's going to be for you. It depends on age rating and all the other things that come into qualification. But 40 years, if we can think 40, 50, and 60 years down the road, or for our children's policies, 70 and 80 years down the road, it can be 5, 6, 7 times the amount of premium paid is available for you to use. So at what point do you want to pay less premium when it's that efficient?
Yeah. And we operate under the assumption that you want to you want to fulfill the biblical mandate of leaving an inheritance to your children's children. If you're of the mindset that I'm going to spend it down to zero and leave nothing for my kids because they need to pick themselves up by the bootstraps, whatever, we're not going to be a good fit to work together. And so if you think longer term than your life and you think of your family as an extension of you, you know that any death benefit, whatever type of policy it is, if it's whole life or term, is going to pay multiples of dollars put in to your beneficiary one day, whether that's your wife or your kids, or a charity, whatever it is. But those dollars are going to multiply. They're absolutely going to, no matter how you structure the policy, a term policy, a base only, or the type that we structure. And so that money is not leaving your personal financial economy. If you expand beyond your life and think of your wife, your children, they're going to get those dollars back regardless. All we're talking about right now when we're talking about PUA is how much of it you can access, and we accelerate that and bring it close to your to much closer to the present by using this PUA. But when we talk about it as a savings vehicle, all these dollars are coming back to your family one day, one way or the other. Um, but the way that people start is with total premium and how much do I need. So we talked about how this isn't just a budget expense. This is a savings vehicle. This has many benefits, but how much insurance do I need? And the needs-based approach is not the way that we approach overall financial strategy. We don't just say this is enough for my family to live on. This is all we need. Like, we want to, if we understand the value of this, we want to continue to grow this policy, which we do via the paid up additions. Because like Brian said, those purchase additional insurance. And that's why 40 years down the road, my policy is many times greater than what the total death benefit is now. And so how much do you need to get started? Like, how do we approach that conversation?
Well, it depends, because at some point, in order to even start this process of becoming your own banker, you have to have some discretionary income, or you have to have some money that's able to be saved somewhere. We believe that you should strive for 25, even 25%, 20%, but we have to start where you're at. And a lot of times people will ask the question of, like, what's the minimum? And I've heard some other people in our space that actually give something to calculate on that. I've heard like 10 times your age as a minimum monthly premium. And I think that's okay. But I really think that first and foremost, in our general economy and our personal, financial disciplines, we need to be saving a substantial portion of our income. So everything I save goes into whole life insurance. I am above 20% of my income now, but it takes some time to do that. And I think that once you understand what's happening here, and you understand the problem, and you understand that banking is the solution, you should be moving to a place that's slightly uncomfortable to pay that premium, but manageable. It should never put you in a place where you're underwater, but it probably ought to make you, as you're having this paradigm shift, it probably ought to make you buckle a little bit. And the reason is because, like, everything we just described, if we have the ability to think long term, one of Nelson's primary tenets, then we know all of this money is coming back into our lives in a very short order, and it's going to be profitable to us through our lifetimes. So at this point in my life, I wish I could get all of my money in. I just simply can't do it because of outside obligations still. But over time, I'm going to keep growing to that goal that all my money flows through insurance first. Does that answer the question?
Yeah, absolutely. And setting that total, we typically see that people initially sit down when they're learning about this, and they start with the scarcity mindset of what I can afford, and not what I'm able to put in, with the understanding of everything we've just laid out. And usually by the end, most people realize, okay, again, we're always coming back to the order of operations, the order in which cash flows into your system. Dollars are coming into your system, and they have to go somewhere. If you're not conscious of where they're going, they're all just going to go to your checking account and be spent over time. But when we look at someone's overall order of operations, typically we can find that, hey, maybe what you're doing here isn't the best use. And again, this is not, we don't need to say it every time, but this is not financial advice to your specific situation. But if you're putting money away into something that you've been told is the first place your money should go, where it's going to be locked up for decades and provide a 1-for-1 return at max down the road before fees and taxes, maybe this is a better place for that capital to start. So we can often find more money than people think they are able to put towards it without increasing their overall expenses. Because again, the money that comes in your system is going to be the same. And we're just figuring out how much of that can responsibly be allocated towards this. And when you understand the value and what we've talked about here, that number typically goes up of what people realize they can put into it. And that was the exact same for myself. And there's a reason that people say the same two things to us every time. And every other IBC practitioner will tell you the same thing. Every client says, I wish I had started this earlier. And every client says, I wish I had gone bigger on my first policy. Because now, 10 years later, my most efficient policy, when we're talking about what the base is doing, again, those PUAs are still getting us a 1-for-1 cash value growth, but the base is now really efficient and producing more than 1-for-1. And their oldest policy is their most efficient one, but it might be their smallest one. You talked about your very first policy was, I think you're in that situation where it was a small policy. People kind of want to dip their toes in because this is a new way of thinking. But we hear it often that people wish they had started bigger sooner. And the reason is because they come to understand what we're trying to convey here, that this is the optimal place for dollars to start. If they're not already spoken for, and you don't have a definite codified plan for where those dollars should go, this is the optimal place for them to flow into first, and then do with them what you will once they are locked into this vault that is efficiently growing, contractually guaranteed forever, and protecting your family and providing you access. What we will talk about, in another Under the Hood episode, how we use policy loans. But if you understand the policy loan and the power of the policy loan and what you can do with it outside the policy, your external rate of return, then it makes sense to flow this money into here first. Does that make sense?
It does. And what I'll say is also, like, I want to go all the way back to where you mentioned that we can typically find places where there's holes in your bucket. And by plugging those holes or optimizing those holes, we can find money without it even costing you extra money to start this process. But there's something else, like, I talked about saving 25%. And for a lot of people that would be crazy. And it's because of something that Nelson describes in his book called Parkinson's Law. So in the book, Becoming Your Own Banker, he describes this. It's from a British essayist named Northcote Parkinson. And he wrote a little, I think it was a pamphlet or maybe a book. I can't recall off memory what it says. I never read his actual essay, but it's called Parkinson's Law. And in that, he describes Parkinson's Law as saying work expands to meet the time allocated or the time envelope allowed. And then, like, a caveat or corollary to that law is that your income, there was a couple of them actually, but income will rise to meet, or excuse me, I said that backwards. Expenses will rise to meet your income. And I think the third one, or the other one he talked about, is a luxury once enjoyed becomes a necessity. So most of us, if you're looking at that and be like, there's no way I could put aside 20% of my money, unless you're 22 years old and just earning your first paycheck, and you're just barely getting through because maybe you're starting at the bottom of your career, likely that your income has increased over time and your expenses have come to match it. You think you're going to get a raise, and then people are like, oh man, I'm going to have this extra $500 a month in my checking account to give me a little breathing room. And before you know it, you spent $499 of it every single month. And you go, where did all the extra money? I've got a $12,000 raise this year and I have nothing to show for it. That's often called lifestyle creep or lifestyle inflation. So an easy way to start saving more is to change that order of operations that Hans was talking about, and have a plan for every time you get an increase in income, how you can start moving that money to have conscious savings, say 50% of it. So let's say you get a $12,000 a year raise, you're going to increase your lifestyle by $6,000, because none of us want to live like we did when we were 21 forever. And you're also going to increase your savings by $6,000. So it's quite possible to get to that 20% over a short order or a short period of time if you actually have a plan to do it.
Yeah, absolutely. And all right, so let's say that the above resonated. I understand that this is a great place for my dollars to start in my financial order of operations. I've expanded what I think I can pay into this because I understand the value of a dollar going here. Now, as a client, how do I break down? You've talked about base, you talked about PUA. I've seen a lot of things online. How do I actually decide how much cash value or how much PUA I want to put in? What percentage of my premium should be PUA? What percentage should be base? How do we, if I'm the client asking that question, how do we approach that?
Well, I want to make sure first that you are thinking long term. So if I can't see past my nose, I'm probably most concerned with having every single dollar available that I pay in premium, or as close to that as possible, to start using, flowing, and all the things you'll find online. And that's okay, I guess, for some people. But if I'm actually thinking long term, one of the tenets Nelson talked about, and when we talk about generational wealth here, so I'm thinking multiple generations down the road. I want those dollars, like I described, 10, 15 minutes ago in this podcast. Every time I pay a premium, it's going to be a multiple of that available. Well, do I want that to be a multiple of a small number or a multiple of a big number? Because eventually the paid up additions have to drop off. And that's because there's something called the modified endowment contract where we can only have so much premium paid in ratio with how much death benefit there is. And we're going to go much more in depth on another mechanics video of that. But if we cross that line or cross that ratio, it can create tax implications that are just undesirable. It doesn't necessarily ruin the policy for everybody, but it becomes very undesirable for using the policy in the process of banking. So we want to avoid that. And and so when I think about that, eventually I know those paid up additions are going to go away. So if I try to structure this in such a way that I have all the cash value and I have huge, super huge PUAs, and that means, and if I'm 25 years old starting the process, now when I'm 55 and probably making the most money I've ever made in my life, I can only put that small amount in when it's now giving me multiples of 3x or more for every dollar I put in. So do I want it to be a small amount or do I want it to be a large amount? So we have to think about all of those things for every individual client and where they are. And I personally believe that the younger you are, the more you should be thinking about having a heavy base premium. And if somebody's 65, they might want to have a lower base premium because they need to get this working for them. Their time horizon is very different.
Yeah, an analogy. There's two analogies that are good that are used a lot for understanding the difference here. The base is the foundation of your policy, and this gets to the tax implications. If we didn't have this tax restriction that Brian mentioned called the modified endowment contract, the MEC as we call it, if we didn't have that restriction, this wouldn't be the case, but it is, and hopefully that'll make sense when we talk about it in the future. But just trust us for now. When we're structuring these, we have to take that MEC into consideration and the point at which we would trigger that event. And so the reason we talk about a higher base, if you think of building a house, if you fit the foundation, base is your foundation. So a 1 foot slab of concrete would be analogous to a small base premium. If you put that small base on, that small foundation, 1 feet of concrete, it's going to be ready and hard and ready to build on very quickly, but you're going to limit the amount of growth that you can do on top of that. Whereas a deep foundation is going to take a little bit longer to set, but what you can build on top of that is a lot more powerful. The other analogy is the roots of a tree. The root system is necessary for larger growth above ground that you can see right now. And so a shallow root system is going to get knocked over by this tax implication much more easily than a deep root system. And so that time preference of money does come into effect. When now there's scenarios, again, there's no blanket information, there's no blanket guidance here. It comes down to each individual's needs. So for instance, one of our clients is an Air Force pilot who's planning to exit the Air Force at his first opportunity due to the same reason that we are both getting out of the military. His goal with his policy is to purchase a homestead, purchase land, and he wants the cash value early enough that he can do that. He recognizes that by dialing down that base portion of his premium, he's reducing his ability down the road to contribute these paid up additions. He understands that, but his time preference, he wants that money to be much more readily available in the form of cash value he can borrow against in a 5-year time frame. And so he understands what he is giving up and prefers a higher percentage of his premium going into PUA. To say that's the right, that's right for everyone would be very short-sighted for most people unless they have a very specific goal for using this money in a time frame like that case. So there's a scenario where lower base made sense for him because he wanted to front load and get that cash value growing as quick as possible for a specific goal, knowing, well, this is just going to truncate my ability to build on this later. But I understand that and I accept that risk. And so it's a personalized based on your goals. And that's part of that holistic look that we take.
Yeah. And you're right. And not only that, but like over time, the value of the PUAs versus the value of the base premium when it comes to how they impact the policy changes. So early on, in the life of the policy, the PUAs are going to give you more cash value because you're getting almost 100% of that available as cash. Whereas in the early years of the base premium, that's where the company takes the expenses on the front end of the policy. So you get very little cash value in the first couple of years on base policy. So early on, the paid up additions, they kind of act like a rocket booster. So when a spacecraft takes off out and supposedly exits the exits the atmosphere,
Allegedly.
it gets those out of the atmosphere and into space. And at that point, they no longer need the boosters because the main engine of the rocket or their spacecraft isn't powerful enough to get it out of the atmosphere alone. So they use these booster rockets. When those fall off, the boosters are like your PUAs. So they're extremely powerful on the front end to get the cash, the dividends, and the engine roaring. But they can fall off at a certain point, and now you have a really efficient engine in that environment. Another way to kind of think of that is as a tree is growing, you know, the paid up additions can only do so much. So no matter what, if I pay $1,000 in paid up additions, I'm only going to get the same amount of cash value available right away. I'm not going to get that multiplicative effect when I pay it every time. So if I keep on adding that in, like if I have a fruit tree, if I have an apple tree, once it is producing at maximum level, a nice mature 20-year-old apple tree that is just massively producing all this fruit, that's the base. To add one more branch that isn't multiplying to that tree doesn't really increase as substantially as what the base has done at that point once that thing has gotten rooted and strong. So it's only adding a little bit of fruit, and it will always add that same little bit of fruit, that same little bit of fruit. So the multiplicative effect is kind of diminished over time of the PUAs. Now, I have to caveat that with saying I build these policies for myself and our clients to accept PUA as long as possible because our cash has to reside somewhere. Our money has to reside somewhere, and there's no better place for it to reside. So if we get to a point where we're highly insured or maybe we're uninsurable, we still would rather put all of our dollars through this policy than anywhere else. So I want to pay PUAs for 30 years. My point is that the biggest effect of them on the banking side and on the cash value side is on the front end. That's where we're going to have them later on. The base policy, the base premiums of what's going to give us our largest dividends and our largest surplus and our largest gain within the policy.
Yeah, and going to the time preference question we've asked before on the podcast, that it's something that is asked of us every time because again, people are spring loaded to think about rate of return, and they look at this and they say, well, what could I get? And most people's time horizon is pretty limited. We're trained. We have to train ourselves to think long term. We had to train ourselves, into Brian and I, to think long term, to think 30 years in the future, to think beyond our lifetime. It takes training and breaking paradigms to do that. But when you put money into your retirement plans, which is where most advisors will say is the first bucket your money should go to, you never ask them, what is my 1-year return, 2-year return, 3-year return? When we talk with clients, they always look at the first couple of years. And so if we're only looking at base premium, that quote return, as far as translated or as indicated by cash value available, it is less in those early years. We increase that by using PUAs, but we are thinking long term here. So unless you're that client who has a very specific short-term goal for cash and understands the trade-off, most of us that don't have that specific goal would do better to build a strong foundation thinking down the road and not looking at what's my 1-year return on my 401k. We talk about emergency funds, and we want to have 3 months of income or 6 months of expenses in emergency fund. That's a great place to be. How often do you use that emergency fund? Ideally, you don't want to use it. And so is that money just sitting somewhere where it's doing nothing other than possibly a high yield savings growth? You want it to at least be getting that as a minimum. Like that should be the minimum return on those dollars. You can put, that's where we can find premium. My emergency fund is now in my policy, growing contractually. If I die tomorrow, it's going to multiply many, many, many times over for my wife to ensure that she and my daughter's financial standard of living doesn't change. But it is doing a lot for me right now, and it's still accessible if I need it. To kind of sum up of what should my breakdown be, we tend towards wanting to build that deeper foundation unless there is a reason and you understand that trade-off. And most people can find more cash to put in than they think they do at the outset of our conversation. As we wrap up, there's a couple more questions that people ask. Do you want to talk about payment modes?
Yeah, sure. There's 4 options for payment mode. You can pay annually, you can pay quarterly, you can pay semi-annually or every 6 months, or you can pay monthly. There's really not a huge deal. There's a small extra fee added for higher frequency payment modes. So it costs you a little bit more to pay monthly than it does to pay quarterly, which costs a little more than it does to pay semi-annually. And it's all based on annual premium, which doesn't have any of those extra fees. A lot of what I say is get started. It doesn't matter. It does not matter which one you choose. If you don't have the annual premium you want to pay up front sitting in an account right now to start, then start monthly. But what I've seen is that most people want to eventually move to an annual payment because it gives you all of the benefits of the entire annual payment available, within a month of making the premium payment. So it's just a time value again, like the time preference of money or the time value. So if you're going to pay monthly, you'll have a slightly lower dividend, and that makes sense because your money has not been it has not been paid. I'm going to say in the policy, but I'm putting that in quotes. But your money has not been paid to the company for the entire year. So if you just compare that to a savings account, if you were going to put $12,000 in there, you're going to have more interest accumulated if you put $12,000 in on January 1st than if you pay $1,000 a month all the way through. So it's the same principle, but really it's better to just get started and not sweat it. This is a small detail. Do the best you can. If you can pay annual, do it. If you can't, go monthly, go semi-annual, whatever. Doesn't matter.
Yeah, and we say over and over, this is not an investment. This is a savings vehicle. We're not, but who is investing is the company, because if I pay my premium, my first year premium, and then I die the next day, the entire death benefit is going to be paid in full. And they were planning using actuarial math. They priced my policy based on my life expectation. And if I die early, they still owe my wife the entire death benefit. And so they're investing. We're not investing. We've offloaded that responsibility to navigate the market to someone who has a contractual obligation to turn our premiums into much more money. And so that speaks to why, like Brian said, an annual, paying it all up front, it allows the company, we're not investing that money, but allows the company to invest that money on our behalf earlier and have longer time in the market. What about the minimum premium? That's another question we often get. What is the minimum I need to get started? Now, this is going to be it depends situation, but how do we generally think about that?
Yeah, it depends. And I think we've already kind of touched on this. I gave the example that came from another practitioner of like they like to use, and I think it's okay, but I think it's low balls, but 10 times your age. And so if you're 30 years old, about the minimum you could do is 10 times that. So $300 per month in premium, but that's going to take you forever to get anywhere useful on the banking side. I like to just think of this as the money that I plan to save, which for me is 20% or more of my income, is going to be used in premium in some way. And then as that cash flow accumulates, that becomes my emergency and opportunity fund. So it's a really difficult question because it depends overall on where your money's already flowing, and can we plug some of those holes? Are you flowing it in poorly? Do you want to change where it flows? It's really, I think, individual.
Yeah, and I'd say that our goal with this podcast and our content and what we try to convey to people that work with us is that we want you to understand why that is the wrong question. That's often a question, but we want you to get to the point where you understand why that is not really a question that matters. Of course, the amount that you put, it scales. The efficiency is going to be the same whether you do $10,000 a year or $100,000 a year if it's the same structure, but it's going to scale to the amount that you put in. You're building a business, and so the more you put into the business, the more growth you will get on a total dollar amount, but the efficiency is the same. But we want you to get to a point where you understand why that's not the question. It's not the minimum, but it's how much can I put in, with the understanding of that these being the optimal places for your dollars to start.
Yeah, you're right. And actually, good correction there on me, because I got into the wrong frame of mind there. It's so easy to do, and I talk about this every day. And rethink your thinking constantly. And I just added a pretty large policy 2 months ago to my system of policies that put me into a place that's a little bit uncomfortable. And it's exactly that, because I understand what's happening, and I don't want to think about the minimum. I'm trying to think about how that's going to look in 30 years and 40 years and 50 years and for my kids, and how I'll have access to that money, and how it helps me take over the banking function in my life by having access to capital. It's guaranteed, efficient, I'm in control of it, and it's liquid.
Yeah.
So yeah, good job. Thanks for correcting me on that, man. I was totally in the wrong frame there, man. That just shows how easy it is to be there.
Yeah. And the questions you have, like, there's no bad questions with this. And like we've said, we talk through all of this with clients, and people that implement IBC know the product they're getting better than any product they've gotten before. People don't spend time deep diving into the specifics of a product that they purchase, any kind of financial vehicle, to the degree that they do with this product. So there aren't bad questions, but we want to continuously try to reframe the way you're looking at this.
And that's good. I want you to jump in and study this. I want you to learn about what you're doing, because I want you to have more control. And the more you understand, the more control you'll have. So I think it's great that people dive in and go so deep with it. But it just is an interesting thing that nobody does that with their 401k prospectus. Either way, keep doing it, man. Dive in, read everything you can, and really, really, really learn what the process of banking can do for your life.
Yep. I'll just say that no one cares more about your finances than you do. And no one has a more vested interest in the well-being of your family while you're here and after you pass than you do. And so you becoming your own banker, it's a process of learning and growing, becoming and your own banker. And so everyone's, it's almost a given that the answers to most of these questions are going to be, it depends, which might be frustrating to hear, but it depends for what we might advise. And especially if we're giving kind of this blanket overview here, but it depends on you, and you should get to that answer of how much premium should you be putting into your policy and what that structure should be. We're going to guide you, but you should understand, and you will get to a point if you work with us where you do understand the answer to all these questions are your own answers that make sense for your situation, and you can explain those and justify them.
It depends. You can when you live on that, you can tell that you were a military instructor pilot. I used to absolutely hate that when I was a student, and everybody you'd ask a question, it was always, it depends.
Yeah.
And then I became an instructor pilot, and that's all I ever told anybody.
Yeah.
But yep, it applies everywhere, man. That runs across over here into finances too. So you got anything else to add, brother?
No, man, that's good. That's the first of our Under the Hood series. We're gonna do a couple of these, and we're gonna try to continuously come back to addressing these specific policy mechanics, because they are very important, and we could talk for hours and hours about the philosophy behind this, which is equally important. But people are going to have inevitable questions, and we know those questions because we get the same ones every time. So that's what this Under the Hood series is going to be, and look forward to talking through some more policy specifics next time.
Yeah, and we're happy to answer any of your questions. We're much more transparent than Biden's handlers. No worries. All right, man. I'll talk to you soon.
All right, brother. See you.